If you sell F&I products and you're not thinking about captive reinsurance, you're leaving money on the table. This is the insider's guide to how dealer captives actually work. The economics, the structures, and the traps. Let's get into it. Here's the core idea. A consumer buys a service contract at a dealership. The dealer sells it, but a captive entity owned by the dealer assumes a share of the risk behind the scenes, run good loss ratios, and that captive pays dividends for years. This is a standard risk transfer, the same mechanism used across industries, just applied to auto F&I. Follow a $2,500 VSC. The dealer remits about $1,100 to the admin. 15 to 25% gets peeled off for admin fees, state tax, and the frontier carrying. What's left is going to be ceded to the captive. There are two separate profit pools here: front-end dealer margin and back-end captive underwriting profit. Most dealers only see the first one. Zoom into one contract and you'll find 6 moving parts: pure risk premium, admin and TPA fees, commission, state tax, fronting fee, and the profit margin. That profit line isn't guaranteed. It's residual, driven entirely by how claims actually perform against the loss ratio target. And there's a hidden lever: investment income on reserves, which is why captives get a lot more attractive when the rates are high. There's no single right structure. A dealer-owned warranty company gives full control, but a heavy licensing burden. The CFC captive, offshore, quota share, has historically been dominant model for mid to large dealers. The 831B micro captive was popular for smaller dealers, but it's been under aggressive IRS enforcement since 2016. And the risk retention groups show up mostly on the liability side, not VSC. Match the structure to your volume and risk tolerance. Every product line has a target loss ratio and a stress threshold. Used vehicle VSCs over 5 years old run 58 to 70% target. Once they cross 80, the program is in real trouble. The tool actuaries actually use to project this is the loss triangle. If your administrator can't produce one, that's not a paperwork gap. It's a sign the program is opaque, and that's where dealers get hurt. This is the part most promoters gloss over. Since 2016, the IRS has treated micro-captives as listed transactions, meaning mandatory disclosures, heavy scrutiny. The pattern they're hunting for: no genuine risk distribution, premiums that aren't arm's length, and cash that loops right back to the dealer. And if you're offshore, GILTI can claw back your tax deferral unless you meet the active insurance exception. This is not a DIY structure. 6 boxes to check before you sign anything. Volume and penetration determine whether your loss data is even credible. Vehicle mix shifts, especially toward higher line imports, invalidate old actuary assumptions. And exit planning goes first, not last. Get the runoff and liquidation protocol in writing before you're in the program, not when you're trying to leave it. 6 signals that should end the meeting on the spot. Guaranteed returns. No independent actuary, a promoter who keeps control of the entity. Claims data you can't see. Artificial year-end pressure. And loss ratios no one will show you. Any one of these is a reason to walk. Several at once means walk fast. Bottom line, the concept isn't the risk. The team is. A properly structured captive, run with real actuary discipline and experienced tax counsel, is a legitimate wealth building tool for dealers with the volume to support it. Get the full breakdown, every structure, every red flag, every negotiation term in the complete playbook. jmjinsights.gumroad.com. Links below. See you in the next one.